Hi, I'm Richard Vague with Tycos. On Monday of this week, the U.S. and China agreed on a 90-day reprieve of the painfully high tariffs recently announced. U.S. tariffs on most Chinese goods will drop from 145% to 30%, and China's tariffs on the U.S. goods will drop from 125% to 10%. Stock markets across the globe rejoiced, with the Dow Jones Industrial Average finally climbing above the level on April 2nd when Trump first introduced these reciprocal tariffs. So it's worth asking, in the middle of all this high-stakes negotiation, what shape is China in economically, really? How capable are they of standing up to an intense trade standoff? One signal comes from the China's central bank announcement this past week of another interest rate cut and an injection of roughly $139 billion into its financial system. As we've mentioned before, rate cuts like these aren't a sign of strength. They're typically a sign of trouble. Central banks lower rates when they are concerned about economic growth and want to give it a boost. You might recall our earlier discussions comparing China's economic trajectory to Japan's experience in the late 1980s. That time, Japan was widely seen as an unstoppable growth engine, expanding at nearly double-digit rates and poised to lead the global economy. But what appeared as robust growth was actually driven by reckless real estate lending. And by the early 1990s, Japan's economy collapsed into a decades-long period of stagnation, forcing interest rates down to nearly zero, where they remained for a generation. Today, we continue to see worrying parallels emerging in China. China, which grew at over 10% annually in the mid-2000s, has seen its growth steadily slow, recently hovering around 5%. The recent interest rate cut further underscores its concern about sustaining this growth level and the overall economic challenges it faces. Here are a few additional warning signs we're closely tracking. Manufacturing activity has weakened significantly, with China's manufacturing PMI dropping to 49 in April. Anything under 50 indicates that factory output is contracting. Notably, new export orders are at their lowest since December of 2022, a direct consequence of ongoing trade tensions and tariff pressures. Youth unemployment, a really alarming social phenomenon in a government that really tries to keep control of its population. Youth unemployment, 16 to 24-year-olds, reached its highest level in over 30 years, indicating weak labor demand and struggling businesses. Companies heavily reliant on the U.S. market have been forced to reduce or halt production entirely, placing workers on leave and creating job instability. Economists are increasingly raising alarms about the risk of recession and rising unemployment across China. Speaking of confidence, the Consumer Confidence Index there fell well below the threshold level of 100 in early 2022 and has remained at this level ever since, implying that consumers feel less secure in their financial situation, something that will bring reduced spending and a hesitancy to take on more debt. As you can see here, that is exactly what is happening. Household debt remains flat at 60% of GDP and has remained around that level since the middle of 2022. All these factors, contracting factory activity, trade uncertainty, slow consumer debt growth, and job instability, point toward deeper structural weaknesses rather than temporary setbacks. And when we see China's government bond yields continuing to fall, it's another confirmation. In 2017, China's 10-year government bond yield was nearly 4%. Now it has collapsed all the way to 1.5%. A clear indication from the market that longer-term growth expectations are weak. In contrast, U.S. yields remain above 4%. Lowering interest rates can provide temporary relief, but that cannot solve fundamental problems such as excessive debt, a troubled real estate sector, and ongoing population declines, challenges China continues to face. And now, as we've seen, been in every newspaper, China faces a massive tariff threat from its number one export destination, the United States. And even if the tariff levels of the 90-day reprieve are kept intact, even at that lower level, it's still a lot higher than the tariffs of 21% when Trump entered office earlier this year, and much higher than they were just, during Trump won, and will be an impediment to its exports. So how is China combating this tariff threat and this emerging economic weakness? Well, for over 40 years, it has had only one playbook and only one play: stoking business and government debt to fund more spending. And it's now returning to that same playbook with a vengeance. Non-financial business bank loans saw a significant uptick in March of 2025, growing from 134 to 139% in the first quarter of 2025 alone. Government debt, including LGFV debt, has climbed to 108% of GDP in 2024. Despite the debt growth in these two sectors, fixed asset investment growth has plummeted, suggesting less confidence in major projects and future growth. Note that China's business sector is already overloaded with debt at 139% of GDP, as compared to only 74%, or more or less half that level in the U.S. Beyond that, China's household and government debt are rapidly catching up to U.S. levels, an astonishing trend for a country that has been so much less developed. China's household debt is 60% as compared to 69% in the U.S., so almost caught up to U.S. levels. And government debt is 108% as compared to 136% in the U.S. Note especially the rapidity with which those high levels have been reached for households and government debt. Meanwhile, there is some news that on the surface seems good. Net exports to GDP continues to climb for China, reaching 6.2% in March of 25. But even that is misleading. As you can see, exports have remained flat since the beginning of 2022, so the increased trade balance is due to a significant drop in imports as a result of a softening demand, industrial overcapacity, and increased trade tensions. So, not an increase in exports, a decrease in imports due to its own internal softness. We'll keep watching these indicators closely, but for now, the evidence continues to support our view that China may be following Japan's path toward a generation of stagnation more closely than many expect. And they aren't in a robust condition to stand up to the U.S. in a trade war, though of course that all depends on how both sides play their hands. That's all for this week. Thanks for joining us.